When you look at a company's stock price, you're seeing what the market thinks it's worth on any given day. But what is it actually worth? Stock prices can be all over the place, right? They're driven by hype, by fear, by a lot of noise. If you want to find the real signal, you've got to look past the ticker symbol and get to the financial heart of the business. And believe it or not, there's one number that tells that story better than any other.
Okay, let's just try a little thought experiment. Imagine a company decides to call it a day. They sell off everything, every factory, every truck, they empty out every last bank account. Then they take all that cash and pay off every single debt they have. The big question is, what's left over? That final number, that's the company's true net worth, and that's exactly what we're going to figure out today. All right, so here's our game plan. We're going to break down what shareholder equity actually is. We'll look at the simple formula behind it, and then we'll deconstruct its different parts. After that, we'll see what it means when the number is positive or negative. And finally, we'll put it all to the test with a real-world showdown. Let's jump in.
So, what is this magic number? Well, it's called shareholder equity. You might also hear it called book value. And it is quite literally the company's official net worth, right there in black and white on its books.
Think of shareholder equity as the ultimate bottom line. It's what would be left for the shareholders, the owners, if the company sold off all its assets and paid back every penny it owed. It is the absolute, definitive measure of what the owners of the company truly own, free and clear.
And the real beauty of this metric is just how simple it is. You don't need some super complex financial model to figure it out. All you need is one of the most basic, fundamental equations in all of finance. And you can find it right on the balance sheet.
And here it is, total assets minus total liabilities. That's it. This simple calculation is the bedrock of the entire balance sheet. It's everything a company owns, minus everything it owes. So simple, so elegant, and incredibly powerful. And the best part, you can do this yourself for pretty much any public company out there. Seriously, just pull up their latest annual or quarterly report, find the balance sheet, and look for two lines, total assets and total liabilities. Do the subtraction, and boom, you've just calculated the company's net worth. Now, to really appreciate this formula, we need to pop the hood and look inside those two big numbers, assets and liabilities. We're going to use a classic consultant's approach here called MEC. It stands for mutually exclusive and collectively exhaustive, which is just a fancy way of saying we're going to cover everything without any messy overlap. It gives us a perfectly clear picture.
Okay, first up, assets. This is all the stuff the company owns that has value. We split this into two main buckets. First, you've got current assets. These are things that are either cash or can be turned into cash pretty quickly, say within a year. Think actual cash, inventory on the shelves, or money that customers still owe them. Then you have long-term assets. These are the things that are built to last. Your property, factories, heavy equipment, and even intangible stuff like patents.
And on the other side of the coin, you have liabilities, everything the company owes to other people. This is also split by time. You've got current liabilities, which are debts that need to be paid within a year. These are the immediate bills, like paying suppliers or taxes. Then there are the long-term liabilities. These are obligations that are due further down the road, like big corporate bonds, long-term leases, or pension promises.
So once you've done the math and you have that final number, the very first thing to look at is whether it's positive or negative. That one little sign is a huge indicator of a company's financial health. It tells you right away if the company is solvent, at least on paper.
It's pretty straightforward. If the equity is positive, that means assets are bigger than liabilities. That's a great sign. The company has more than enough firepower to cover all its debts. But if it's negative, that means liabilities are actually greater than assets. This is called balance sheet insolvency, and it's usually a pretty big red flag. Now, context matters, of course. A fast-growing startup might have negative equity for a while, and that's okay. But for a big, established company, it could be a signal of some serious trouble.
And this really gets to the heart of it for any investor. A company with negative equity is fundamentally underwater. It owes more than it owns. That doesn't automatically mean it's going bankrupt tomorrow, but it definitely signals a whole lot of risk. Because if things did go south, there would be absolutely nothing left for the owners.
Okay, enough with the theory. Let's make this real. We're going to put this metric to work with a head-to-head comparison between two absolute giants of the soft drink world, Coca-Cola versus PepsiCo.
So check this out. At the end of 2024, PepsiCo's shareholder equity was sitting at about $18 billion. But look at Coca-Cola.
They came in significantly higher at over $26 billion. Now, both are solidly in the positive, which is exactly what you'd expect from these titans. But that gap between them, that's not just a random number. It tells a story about decades of different decisions about debt, about dividends, and about how they've managed their assets. This is the kind of deep insight a stock price just can't give you.
So let's bring it all home. Why do we care so much about this one number? Because it cuts through the noise and gives us a much clearer picture of a company's financial reality. It's also the foundation for one of the most important financial ratios out there, return on equity, or ROE. You just take the company's net income and divide it by the shareholder equity. What that tells you is how good management is at using the owner's money to actually make more money. A higher ROE, that's a great sign of an efficient, well-run company.
So the next time you're looking at a company, don't just stop at the stock price. Dig a little deeper. Go find that balance sheet and calculate the shareholder equity yourself. You now have a really powerful new lens for seeing a company's true financial foundation. The only question is, which company are you going to analyze first?